We're going to move now to our special address from Mr. M. Rajeshwar Rao, Deputy Governor of the Reserve Bank of India, a career central banker. He's been with the Reserve Bank since 1984. Of course, at this point, he's looking at several crucial pillars, including regulation, enforcement, risk monitoring. We have heard his comments around microfinance and, of course, around the entry of big tech into the world of finance. And if the questions in the guest room were anything to go by, sir, everyone's waiting to hear from you both on inflation, on what's happening with the currency, and much more. Sir, could we have you on stage, please?
I hope my voice is audible all around. Yeah, thank you. Good evening, everybody. Thank you for inviting me to this evening to the Mint's Annual Banking Conclave. The organizers have quite aptly selected an extremely topical and contemporary theme, the future of banking, navigating a digital opportunity for this year's conclave. During the previous edition of this conclave, I remember Governor Shaktikanta Das speaking about digital disruptions and blurring of boundaries between traditional banks and fintech, as well as big tech. Looking at the constellation of speakers who have been engaging with you, I'm sure you have had an extremely enlightening discourse on several of the emerging issues during the conclave. The technological and digital innovations have improved the efficiency, productivity, and competitiveness in the delivery of financial services. Their role in furthering financial inclusion and reducing the cost of financial intermediation is well recognized. However, such innovations have also given rise to newer challenges for all stakeholders. While customers face issues of mis-selling, data security, privacy, as well as identity theft problems, regulators and supervisors need to increasingly engage with issues around customer protection, ethical conduct, regulatory arbitrage, and concerns about financial stability. In turn, the regulated entities need to be on their toes to face up to ever-changing competition and business disruptions through technology-driven innovations, which require them to fine-tune and sometimes alter their business plans, reorient their strategies, and manage the concomitant risks. In this backdrop, I thought I could briefly focus the spotlight on the business conduct and governance issues in financial services, which assumes greater relevance in times of innovation, change, and business disruptions. These, in my view, are the key soft pillars which build the edifice of a successful financial institution, more so in these challenging times. In particular, there is a need to reflect on the role and expectations of the governance architecture, that is the board and its committees, the independent directors, the assurance functions in the bank, and other financial institutions. Before I talk about governance-related issues, let me briefly dwell upon the concerns around ownership and corporate structure for private sector banks, drawing largely on the recommendations of the internal working group constituted by the Reserve Bank to examine these issues. The Reserve Bank had accepted 21 out of the 33 recommendations made by the group and had announced this decision on November 26, 2021. However, there are some issues where the recommendations have been extensively debated and therefore require further examination. Looking at licensing and ownership of private banks in India, it is generally accepted that a deep, stable, and sound financial system contributes to economic growth. But for the group to be truly inclusive, broadening and deepening the reach of formal finance is a prerequisite. Access to formal finance is especially critical for the lower income groups, as it provides them with opportunities to save, invest, avail of credit, and grow their incomes through productive enterprises and activities. This provides them the much needed insurance against future income shocks and helps them to manage emergencies. The guidelines for licensing of new banks in the private sector issued by the Reserve Bank since the initiation of the financial sector reforms in the early 90s have been guided by this philosophy. In addition, the choices have also been informed by the need to instill greater competition in the banking system to increase productivity and efficiency. So far, 8 sets of licensing guidelines have been issued by the Reserve Bank, of which 4 are for the universal banks and 4 pertain to differentiated banks.